Welcome to the pre-market insight extended for April 21st, 2020. We have lots of action going around the globe pertaining to oil, gold, the S&P. Let's take a look at the charts. So we're taking a look at the S&P 500 futures. Now we're coming in down just about 57.5 points, call it 2%. Just about 58 points on the ES. And we really are in such an interesting environment because you have to be nimble and always looking for the nuances, the slight changes in market participant behavior to give you a clue or a tip-off, as I like to call it, as to the direction of price action in the short term. Because that's all that anyone can reasonably do given the type of volatility that we have playing out in the markets. And keeping it very simple, smarty, we're going to make a shorter video today just so we can condense all of the key actionable items of information that you guys need to know going forward. We need to see this 27.46 level. How are we going to hold? And the importance of this 27.46 level, as you can see, if we just drill down to the shorter term time frame, the 1 hour, you can see right here, we have this area of consolidation, an area of balance here, going back to the left, that corresponds to that just around 27.50 to 27.46, most recently the low that we put in around there. Can the bullish market participants be aggressive enough on the bid to hold the market up here at 27.46 and make a stand? That's the real question that needs to be answered today for the ES. To the upside, if we do hold the 27.46, then of course the natural target would be again looking for the underside of the break of yesterday's range at 28.21, back here at the low of Friday's range, which was the close at the low of the range at 28, let's call it 28.21. Let's take a look at the gold. And gold, as you can see, is moving in step with the ES. And sometimes you will find that there is both a negative correlation between gold and the S&P 500, i.e. they move in opposite directions. Not an exactly one-to-one correlation, but generally speaking about between 75 to 85, 0.75 to 0.85 negative correlation, i.e. they tend to move oppositely because gold is considered by most to be a safety asset or a risk-off asset, whereas the S&P 500 is considered to be a risk-on asset as an equity, as opposed to gold, which is a physical commodity that can be held, that can be used as a store of value. So when investors and or short-term traders are looking for risk-off plays, typically you find gold being bid, whilst equities, the S&P 500, the NASDAQ, the Russell 2000, the Dow Jones, etc. are sold off. However, we have a situation where both gold and thus far the S&P are moving in a fair lockstep and correlation. So I also would be looking for a bid in gold to hold that may then lead into the bid under the equity market as well, holding. If both of these investment vehicles and classes continue to go down, then that may portend to lower prices both in the short and intermediate term. So what are we looking at here in gold? We spoke about the importance of the 1680 level that we have now broken to the downside, but in the very short term time frame, we do have this nice area of consolidation right here between a high of just about 1693 and a low of about 1671, right where we are at in the pre-market. If gold cannot hold 1671, then if we zoom back out to the 4-hour chart, you can see that we have some levels beneath that are not fairly significantly below. But because gold is so volatile and moves so quickly, you need to be aware of your position sizing. You need to be aware of your the max capital at risk and obey your stops in this one, particularly as we're now just having some responsiveness by sellers. We can wash lower before we find some reversal intraday or later on in the week. So please obey your stops on these particularly volatile instruments. If you look to the left, we have several areas of consolidation just at around this 1650 area. Let me highlight those. Right here, right here, right here. So this level between 1630 and just around a high of 1655 are particularly important for gold. We could see a wash down into those levels before we reverse to the upside if this 1671, 1670-ish level on gold does not hold to start the session. Let's take a look at CL, crude oil. Now this is the chart that is on everyone's lips for the past day or two because we had the negative figures that were trading yesterday in the May contract. However, there is a bit of nuance that you need to understand about futures in terms of how they trade and the switching from one contract to the next. But before we go into that, let's just zoom back out to, for me, the tell on oil for the longest while. And the tell on oil was that we had a very tight consolidation between this level here at around $50 and a high of just around $63.50. So once oil broke that 50 level to the downside, it was always going to attract both long-term time frame participants as well as algorithmic. We always speak about the box traders as well. Computers that would be selling oil to the downside on a break of that very clearly defined level, and oil simply has not recovered from there. And if we zoom back out even to the 15-year quarterly chart, you can see this even more clearly. This level right here at just around $35. Having broke that level again from the active intermediate term time frame, once we broke 50, the next level down was 35. And look how we responded to 35. You can see that we were bouncing around there, trying to hold right here. On that short opportunity, we never came back to test 35. And since then, have just been very orderly selling off and having some bounces on, some positive news headlines pertaining to collusion. But always be aware of the time frame that you're dealing with, particularly in oil. And given the fact that we're in a clear downtrend, and I'm going to go to the max yearly chart on oil so you can see this even clearer. You can see that essentially oil was in a very wide-ranging consolidation between, we want to go between these levels right here. And lo and behold, what were these to the downside? The close here was 37. The open here was 37.60. So this 37.60 level to the downside, again, which probably more lines up to the 35 level on the intermediate time frame. From the time that this was broken and we did not recover into higher levels, oil was in essence destined to continue falling. So where might we find some level of support? Well, I was about to say God alone knows, but that doesn't really cut it for active traders. So you'll have to go back to levels that we have not seen for quite a number of years, going back into the 99, 90, 95, 85, when I was born, to find levels on oil here. So to say the least, this offers both opportunity and heaps of risk. So oil for me is not an overnight long until we begin to stabilize, until we see several days and several perhaps weeks of stabilization on oil so that we can determine a clear pattern and level to go long against. Because we have levels much lower down into a low of 975, if my chart reads correctly, that oil can possibly trade down into. So, given the fact that we've spoken about the fact that oil is a particularly volatile instrument, you do not want to be playing around with it here if you are not an experienced trader and or you are willing to obey your stops, because given the not only the volatility but the cost of margin to hold that oil contract, particularly if you're trading the futures, of course, this can very easily be an account wrecker. And there's no real reason to do that at this point when we have so many opportunities, both the long and the short side, where we can better control our risk. That does offers us asymmetric risk to reward opportunities. So let's take a look at the just 2 or 3 more names as we're coming up to the bell. Look at TLT bonds. So we're currently bid 172 in the pre-market, and if we zoom down to the lower term time frame, we've been speaking about the fact that provided coming out of this nice, very tight consolidation that we had in TLT between just around 163 and a high of around 166, that we would be looking for levels higher, provided that we break and close above that. And we got that break and close last Tuesday, and now we're looking for active levels to the upside. We spoke about the fact that for the short-term time frame, we had this 170 level as a very clear line in the sand on this big run that we had into the sell-off into the I guess the coronavirus panic lows, that we saw a bid under bonds. 170 clearly was a level to the upside that we rejected once, twice, 3 times, but now in the pre-market we're trading above it. Given the fact that we're now trading above it, we have to be looking for active levels above. And we spoke here about this 172.93 level. Of course, we're trading 172 in the pre-markets. So I would definitely think that the next push would be possibly into that 172.93 level. So the next logical target would be 177.32 on TLT. See if we get there sometime this week if we continue to see protracted weakness in the equity markets especially. Let's take a look at Netflix because we have earnings later on this evening. We're currently trading 446, which, as you know, 449 was the all-time high set on last Thursday, trading 446. Then natural first target to the upside is 449 and possibly see what we can do beyond there. Again, as I admonished before, given the fact that we've had this monster on almost 14% in Netflix in a matter of 4 days, I would not be chasing Netflix here into earnings unless it's on a tactical intraday basis. If you'd like to perhaps go long against this, that 433 level, looking for whatever upside into the number this evening, then be my guest, consistent with your account size, your risk tolerance, your time frame, then by all means do so. But we can very easily see, as we talked about yesterday, Netflix is pricing in just about, I believe, let's update that today. It is pricing in a $54 move to the upside. So let's round it up that we're trading 445. Then we're looking at 490, which is just 10 points away from a psychologically important number of 500. So we possibly could see this week Netflix trade into 500, or to the downside, we can very easily see us retest the 380 level from which we broke out earlier on last week. Let's take a look at Apple. Now, Apple I always refer to as a bit of a market leader and a market general. What Apple tends to do, given the fact that it's, of course, one of the biggest, if not the biggest, weighted market cap in the S&P and the NASDAQ, Apple tends to hold the market up or drag the market down depending on the aggression of the bid in Apple. Now, we were previously trading 271 on Apple in the pre-market, and I see that we're now trading 274. So we do have some buyers coming in on the bid, but I'm sure we'll see that 272 level possibly retested in the opening, possibly hour and a half of trading, to see if we do, in fact, find buyers there to protect us from filling this gap, this clear gap here The close was at 273.22, so the gap was closed in the pre-market, but let's see if we can test that during regular trading hours as well. If we do defend this gap, then Apple has earnings coming up, I believe, on the 29th, so that is next week, just around the same time as Google as well. Apple may be setting itself up. This dip buy into this 273, possibly 270 level would be an excellent opportunity to scale some Apple long, looking for a retest of the other side of the range here at 288 into that number next week on the 29th. And we're going to just look at one more. Look at Shopify. Again, on everyone's lips because of this monster run-up that we've had. And I would not be, again, holding Shopify short overnight because of the crazy aggression on the bid that we're seeing in demand. We're seeing in Shopify. The thing about it is, we often confuse what we want to happen or what we think should happen with what is actually happening. And if we zoom out to the forward chart, you can see that Shopify was going gangbusters on its earnings that it announced earlier on in February. It made a high of 593 before begin with the market to experience a very quick downdraft. So Shopify went all the way from just around 600 to a low of around 300. So effectively cut in half within that 3-week period. Had a bounce, had a bit of a sell-off, made a higher low, and look at what we're doing now. From a low of around 335, we are now testing, of course, broke out to an all-time high and testing levels higher at 650, essentially. Now, this is what we talk about when we speak about identifying relative strength and weakness. While the market is seeking and possibly going into price discovery lower, Shopify is actively discovering price above. And on market weakness, it is just holding its levels, consolidating, and the natural conclusion from that is once the market begins to even stabilize just a bit, Shopify is going to continue to run. So personally, from my trading strategy, I would not be chasing Shopify here. I think that risk asymmetry is more to the downside than the upside, but I'm not going to be the first short in to get run over either. What I want to see is a capitulation, an exhaustion high, and then have that level to lean short against going forward. And I would not be outright shorting. I would probably be selling calls into it, as there will be dip buyers for the first at least 2 or 3 days looking to try to stabilize the stock even into any capitulation high. So I would be selling calls as momentum slows down, and then as momentum begins to retrace, then probably you can look to play this with some active puts or some equity to the downside. All right, guys, so we'll close it up there for today. Thank you for joining me for the Pre-Market Insight Extended, and I will see you this evening for a market recap and tomorrow morning by God's grace. Be safe out there today, guys. Cheers.